A credit union is a financial institution that is member-owned and operated, providing financial services to its members. Credit unions are similar to banks in many ways, offering a range of financial products and services, but they differ in their ownership structure, governance, and mission. Key characteristics of credit unions. Ownership. Credit unions are owned by their members, who are also their customers. Each member typically has an equal vote in the credit union's governance, regardless of the amount of money they have deposited. Non-profit structure. Credit unions operate on a not-for-profit basis. While they aim to generate income, any profits made are typically returned to members in the form of higher interest rates on savings, lower interest rates on loans, or additional services. Membership requirements. Credit unions often have membership requirements based on a common bond among members, such as belonging to the same community, employer, or organization. Some credit unions have more open membership criteria. Focus on member service. The primary goal of credit unions is to serve their members' financial needs. This focus often translates into personalized service, lower fees, and more favorable interest rates compared to traditional banks. Governance. Credit unions are governed by a board of directors elected by the members. This democratic structure ensures that members have a say in the credit union's policies and direction. Community orientation. Credit unions often emphasize community involvement and support. They may be more connected to local communities and have a mission to serve the financial needs of their members. Differences between credit unions and banks. Ownership and structure. Credit unions are member-owned cooperatives, while banks are typically owned by shareholders and operate for profit. This ownership structure influences how profits are distributed and the level of member influence in decision-making. Profit distribution. Credit unions, being not-for-profit, aim to benefit their members. Profits, if any, are returned to members in the form of dividends, reduced fees, or improved services. Banks distribute profits to shareholders in the form of dividends. Membership criteria. Credit unions often have membership criteria based on a common bond, such as location, employer, or association. Banks generally have a more open membership, allowing anyone to become an account holder. Service and fees. Credit unions are known for offering competitive interest rates on savings and loans, as well as lower fees compared to many banks. Their focus on member service can result in a more personalized banking experience. Size and accessibility. Banks, especially large commercial banks, tend to have a broader geographic presence and a larger network of ATMs. Credit unions may have a more limited branch network, but many participate in shared branching networks to enhance accessibility. Regulation. Both credit unions and banks are regulated financial institutions, but they may be subject to different regulatory agencies. Credit unions are often regulated by the National Credit Union Administration, NCUA, in the United States. While credit unions and banks have differences, both play vital roles in the financial industry, providing a range of financial services to consumers and businesses. The choice between a credit union and a bank often depends on individual preferences, membership eligibility, and the specific financial needs of the account holder.